Florida home prices have fallen as much as 15% from their 2022 peak. Inventory has surged over 40% year over year, according to Florida Realtors data. And across 10 towns once marketed as the last affordable paradise, for sale signs now outnumber buyers 3 to 1. The median list price in these communities sits under $190,000, less than half the national median of $417,000. The brochures still promise sunshine, wealth, and early retirement. The drone footage still shows palm-lined streets and sparkling canals. But the real story isn't about cheap houses. It's about why nobody wants them. Today, we're counting down 10 Florida towns where prices collapsed, dreams stalled, and the math finally caught up with the myth. If you find value in this breakdown, subscribe now, and tell us in the comments whether you see cheap homes as opportunity or trap. The for sale signs are multiplying. Let's find out why. Number 10. Palatka, Florida. In Putnam County, along the banks of the St. Johns River, sits Palatka, a town that once drew retirees and young families seeking riverfront charm within reasonable commuting distance of Jacksonville. The historic downtown with its brick storefronts, the slow pace of life, the affordable quarter-acre lots, it all seemed like a smart bet for anyone willing to trade urban convenience for small-town value. The azalea festivals drew visitors every spring. The fishing was reliable. The promise was simple: buy low, live well, watch your equity grow. Today, the median home price hovers around $165,000, according to Zillow's 2024 data. That sounds remarkably affordable, until you realize prices have stayed essentially flat since 2019, while the national market climbed over 40% during the same period. Homes here linger on the market an average of 78 days, nearly double the U.S. average of 45. Some listings have crossed the 6-month mark without a single serious offer. One retired couple relocated from Orlando 3 years ago, trading traffic and rising costs for what they believed would be peaceful affordability. They purchased a 3-bedroom home with river views, imagining grandchildren visiting for summers. Now they watch neighbors list homes that don't sell, watch asking prices drop $10,000 at a time, watch the dream of building equity evaporate. The cause isn't mysterious. Job growth in Putnam County remains minimal. Healthcare infrastructure is limited to a single hospital struggling with staffing shortages, and the economic base never diversified beyond government employment and retail. Those isolated for sale signs dotting Palatka's residential streets aren't clearing. They're aging in the Florida sun, their colors fading, their optimism unrewarded. What looked like affordable opportunity increasingly looks like stagnation priced as a bargain. And Palatka was still one of the better cases on this list. Number 9. Clewiston, Florida. Head south into Hendry County, where Lake Okeechobee's vast waters once anchored an economy built on sugar and agriculture. Clewiston proudly called itself America's sweetest town, and for decades, that title carried real economic weight. Workers found steady employment at the sugar mills and processing facilities. Modest homes stayed within reach of families earning working-class wages. The lake provided recreation. The industry provided stability. It wasn't glamorous, but it was sustainable. Or so it seemed. Redfin data now shows the median home price in Clewiston around $170,000, down 8% year over year, while Florida's overall market edged up approximately 2% during the same period. That divergence tells a story. Inventory has climbed 52% in just 12 months, meaning the supply of homes for sale has increased by half, while demand has moved in the opposite direction. One sugar mill worker recently listed his 3-bedroom home after realizing the commute to Fort Myers for better-paying work had become financially and physically unsustainable. 90 minutes each way, 5 days a week, burning gas while his Clewiston property lost value. The math stopped working. He's not alone in making that calculation. The agricultural sector that built this town is contracting as automation advances and commodity prices fluctuate. Jobs that existed for generations are disappearing, and nothing has arrived to replace them. Meanwhile, insurance premiums have spiked across inland Florida in ways few homeowners anticipated. Properties that cost $1,200 annually to insure now require $2,000 or more. That's hundreds added to monthly carrying costs on homes that aren't appreciating. What was once affordable to buy is becoming unaffordable to keep. The first wave of price cuts has already rolled through Clewiston's listings. Sanders, who waited for the market to recover, are now racing to get out before values fall further. And the trend was only accelerating as we move deeper into Florida's interior. Number 8. Live Oak, Florida. In Suwannee County, about an hour north of Gainesville, Live Oak marketed itself as quiet North Florida living, a place where retirees could stretch fixed incomes and young families could find breathing room unavailable in the state's crowded metro areas. The rolling terrain, the springs, the sense of genuine small-town community drew buyers who wanted something different from subdivision sprawl. Home prices remained modest. Property taxes stayed manageable. The pitch was compelling. The median home price now sits around $185,000, according to Zillow, still 5% below its 2021 peak, while most of the country has not only recovered, but pushed to new highs. That persistent gap reveals something important. This market never bounced back because the buyers never returned. But the warning signs in Live Oak go deeper than home prices. The rental vacancy rate has climbed to approximately 12%, meaning more than 1 in 10 rental units sits empty. For a small town, that's a significant signal. One small landlord with 4 rental properties reports losing Section 8 tenants as the county's population stagnates and younger residents leave for cities with actual job markets. They go to Jacksonville, they go to Orlando, they don't come back, he explains. His rental income has dropped 30% in 2 years, while his property taxes have risen, squeezing him from both directions simultaneously. Drive through Live Oak on a Tuesday afternoon, and you'll notice the empty driveways, the silent streets in the middle of what should be a workday, the sense that something has quietly shifted beneath the surface. The Dollar General stays busy. The local restaurants turn over ownership. The for sale signs remain. Tell us in the comments, have you seen this pattern in your own town? That slow drain of population, opportunity, and optimism that doesn't make headlines but changes everything? This is where the trends stopped being subtle and started becoming undeniable. Number 7. Sebring, Florida. Highlands County was snowbird country for generations. Sebring, with its dozens of lakes and affordable golf courses, drew Canadian and Midwestern retirees who bought modest homes and settled into warm winters away from ice and snow. The annual 12-hour race at Sebring International Raceway brought attention and tourism dollars. The citrus groves provided scenic drives. For decades, the formula worked. Retirees arrived with fixed incomes, bought homes outright, and lived comfortably on Social Security and modest pensions. The median home price in Sebring now sits around $189,000, down 14% from the 2022 peak. For context, U.S. home prices overall remain approximately 5% above that same 2022 peak. The national market recovered. Sebring did not. That 14 percentage point divergence represents tens of thousands of dollars in lost equity for homeowners who bought at the wrong time. One Canadian retiree purchased a Sebring home in early 2021, planning to split his year between Ontario and Florida. He paid cash, expecting the property would at least hold value while providing winter warmth. Now he's trying to sell, at a loss, because the carrying costs have become unbearable. HOA fees at his community have doubled as the association struggles to maintain aging infrastructure with fewer dues-paying members. Homeowners insurance has become nearly impossible to obtain at reasonable rates. His premium tripled in 3 years, and 2 insurers have exited the Florida market entirely since he purchased. That's the pattern emerging across these towns. It's not just purchase price that matters, it's total carrying cost. When insurance quotes come back 50% higher than the previous year, when HOA special assessments arrive to repair decades-old roofs. When property taxes rise, even as values fall, buyers do the math and walk away. The price-reduced signs are stacking up along Sebring's quiet streets, each one representing another seller's capitulation to market reality. But Sebring wasn't even close to the worst on this list. The acceleration was just beginning. Number 6. Arcadia, Florida. DeSoto County sits about 45 minutes northeast of Sarasota, and for years, Arcadia absorbed the overflow. Commuters and young families priced out of the coast who were willing to trade a longer drive for significant savings. The Victorian-era downtown had charm. The antique shops drew weekend visitors, and home prices that seemed impossibly low compared to coastal Sarasota County made the compromise feel worthwhile. Buy in Arcadia, commute to Sarasota, build equity while the coastal market climbed ever higher. That was the theory. Today, Redfin shows a median home price in Arcadia around $175,000, and inventory has surged a staggering 68% year over year. For every 3 homes on the market last year, there are now 5. Sellers are flooding the market while buyers retreat. Job growth in DeSoto County has turned negative, down 1.4% annually, meaning the local economy is actually shedding employment rather than creating it. One young family who bought in Arcadia in 2020, a teacher and an electrician with 2 children, recently listed their home after flood insurance quotes arrived. The premium had tripled from the previous year, adding nearly $300 monthly to their housing costs. The home isn't in a designated flood zone, but insurers have expanded their risk models across inland Florida, and Arcadia fell within the new boundaries. We can't afford to stay, and we can't afford to sell at what we owe, the teacher explains. They're considering walking away from the mortgage entirely. Across Arcadia, this domino effect has become visible on every residential street. Insurance spikes make homes harder to afford, which makes them harder to sell, which pushes prices down, which traps owners underwater on mortgages that exceed their home's market value. Listings that don't sell after 60 days get relisted at lower prices, then lower again. The pattern feeds itself. If Arcadia's story is fundamentally about the insurance trap, about carrying costs that exceed any possible equity gain, the next town story is about something even harder to escape, an economy that simply stopped functioning. Number 5. Lake City, Florida. Columbia County anchors a logistics corridor along Interstate 75, positioned roughly halfway between Jacksonville and Tallahassee. Lake City built its economic identity around that geography: distribution centers, trucking companies, warehouse operations, and the jobs they provided. For years, steady blue-collar work supported modest but stable home values. Workers could afford single-family homes on warehouse wages. The cost of living stayed low. The formula wasn't exciting, but it functioned. The median home price in Lake City now sits around $180,000, down a remarkable 17% from the 2022 peak. Here's the impossible statistic that reveals the depth of the problem. Price cuts now appear on 42% of active listings. Nearly half the homes currently for sale in Lake City have already been reduced at least once. Sellers are chasing a market that keeps falling away from them. One truck depot supervisor bought his home in early 2021 with a 5% down payment, believing his stable employment and the area's logistics growth would protect his investment. Today, he owes significantly more than his home is worth. The logistics slowdown that rippled through the national economy following the pandemic-era boom hit Lake City with particular force. Distribution centers that expanded during the shipping surge have contracted. Layoffs have followed. When the primary employment sector of a small city cuts shifts and eliminates positions, the effects cascade through every other part of the local economy. Restaurants close, retail stores shutter, service providers lose customers. The housing market absorbed all of that pain. Layoffs led to missed mortgage payments. Missed payments led to forced sales. Forced sales at distressed prices pushed comparable values down for everyone else. Falling values created more underwater homeowners, which created more distressed sales, which pushed values down further. The cycle feeds itself until something breaks it, and nothing has arrived to break it in Lake City. If you're finding this breakdown valuable, subscribe now so you don't miss the final entries. We're approaching the true epicenters. The moving trucks leaving Lake City aren't hauling commercial goods anymore. They're hauling families and their remaining possessions. This is where optimism finally died. Number 4. Port St. Joe, Florida Gulf County's coastline, once qualified as one of Florida's legitimate hidden gems. Pristine beaches without the crowds, turquoise water without the high-rise condos. The kind of place travel magazines featured as an authentic escape from manufactured resort towns. Port St. Joe and the surrounding area drew investors, vacation home buyers, and early retirees looking for appreciation potential and rental income in a market that hadn't yet been discovered by the masses. Cape San Blas offered some of the state's most beautiful and least developed shoreline. The promise was appreciation plus income plus paradise. The median home price in Port St. Joe has fallen to around $215,000, down 21% from the 2022 peak. Meanwhile, Florida's coastal real estate markets overall remain up approximately 6% since 2020. The divergence is stark. Most of Florida's coast recovered and then some, while Port St. Joe gave back years of gains. What happened? The explanation involves multiple colliding forces. One Airbnb investor purchased a Gulf County beach property in mid-2021, expecting steady vacation rental bookings to cover the mortgage while the property appreciated. Bookings have dropped significantly as travelers discovered or rediscovered competing destinations with better infrastructure and more reliable services. But the rental income decline was survivable. The insurance situation was not. Coastal properties in Gulf County have become nearly uninsurable at rates that make ownership economically rational. Hurricane Michael devastated this region in 2018, and insurers have never forgotten. Policies that cost $3,000 annually before the storm now cost $12,000 or more, if coverage is available at all. Several major insurers have exited the Gulf County market entirely, leaving property owners scrambling for coverage from smaller carriers with higher premiums and more exclusions. The escape to paradise dream that drew investors and retirees to Port St. Joe became a trap when carrying costs exceeded any possible return on investment. Beachfront homes now sit on the market with no buyers, not because they aren't beautiful, not because the sunsets aren't spectacular, but because the financial math no longer works under any reasonable assumptions. And then insurance made everything truly catastrophic in the towns that remain on this countdown. Number 3. Belle Glade, Florida. Palm Beach County contains some of the wealthiest zip codes in America. Oceanfront estates, country club communities, addresses that signal arrival and success. And Palm Beach County also contains Belle Glade, one of the poorest cities in the United States. For decades, agricultural employment anchored this community on the southern shore of Lake Okeechobee. Workers harvested sugarcane, vegetables, and citrus. Modest homes, many of them older, many requiring ongoing maintenance, remained within reach of families earning agricultural wages. The work was hard, the pay was low, but ownership was possible. The median home price in Belle Glade has dropped to approximately $150,000, down a stunning 19% year over year. But here's the statistic that explains everything else about this market. The poverty rate in Belle Glade exceeds 38% according to U.S. Census Bureau data. More than 1 in 3 residents lives below the federal poverty line. In some census tracts, the rate exceeds 50%. When agricultural jobs contract and nothing replaces them, when wages stagnate while costs rise, when the economic foundation of a community crumbles, housing prices become almost irrelevant. It doesn't matter that homes are cheap, if the residents can't afford even cheap homes. It doesn't matter that prices have fallen, if there's no one with stable income to buy. Foreclosures have accelerated as families lose the ability to keep up with payments. Investors who once purchased rental properties in Belle Glade, attracted by low prices and Section 8 guaranteed income, have begun fleeing when tenants can no longer pay even subsidized rents, when maintenance costs exceed rental income, when the trajectory becomes undeniable. One farm worker family was recently displaced after their landlord sold the property, at a loss, simply to exit a situation that had become financially untenable. Drive through Belglade, and the visual evidence is impossible to ignore. Boarded windows on homes that will never sell at any price. Overgrown lots where properties have been abandoned. The infrastructure of a community that's contracting rather than growing. The systemic pressures, job loss, generational poverty, investor flight, insurance costs, infrastructure decline, have created a cycle that cheap prices alone cannot break. What would it take to reverse Belglade's trajectory? No one has a convincing answer, but the next town on this list shocked even analysts who thought they'd already seen everything Florida's collapsing markets could produce. Number 2. Perry, Florida. Taylor County sits along Florida's Big Bend coast, a region that never attracted the development or attention of the state's more famous shorelines. Perry, the county seat, built its economy and its identity around one industry for over a century: paper. The Foley cellulose mill, now operated by Georgia Pacific, employed generations of Perry residents. Workers graduated from high school, got hired at the mill, and bought homes within a few miles of work. Their children often followed the same path. Modest homes lined quiet streets, sustained by steady paychecks from an employer that seemed permanent. That economy is now collapsing, and the housing market is collapsing with it. The median home price in Perry has fallen to around $135,000, down 26% from the 2022 peak. That's not a correction, that's a catastrophe for anyone who purchased in the past 5 years. Here's the impossible statistic that stops observers cold. Inventory has surged 112% year over year. For every home on the market last year, more than 2 are listed now. The supply has more than doubled, while demand has essentially disappeared. Mill layoffs cascade through a small town with terrifying speed and predictable sequence. When the primary employer, the employer that directly or indirectly supports nearly every other business in town, cuts shifts, mortgage payments get missed. When mortgage payments get missed, homes hit the market as distressed sales. When too many distressed homes hit the market simultaneously in a town with limited population, prices crater. When prices crater, homeowners who aren't yet distressed become underwater, which creates anxiety, which creates more listings, which pushes prices down further. One mill employee who had worked at the facility for 11 years listed his home recently at a significant loss, simply to escape before values fell further. "I could see where it was heading," he explains. "I took a $40,000 loss to avoid a $60,000 loss next year." He's relocating to Georgia, where paper mills still operate, and where he hopes the housing market is more stable. Entire blocks in Perry now display for sale signs. Not 1 or 2 homes, but 4 or 5 on a single street. The paper mill economy that sustained this town for over a century is unwinding, and nothing has emerged to replace it. No tech companies are relocating to Taylor County. No distribution centers are under construction. No tourism boom is arriving to rescue local businesses. Subscribe now before we reveal number 1, the town that everyone, including the most cautious analysts, thought was completely untouchable. Number 1. Cape Coral, Florida. Lee County's Cape Coral was the Florida success story, the proof that Sunbelt growth could continue indefinitely, that demand would always outstrip supply, that buying early in a growing market was the closest thing to guaranteed wealth. From 2010 to 2022, Cape Coral was frequently cited as the fastest-growing city in Florida, sometimes the fastest-growing in the entire nation. The canal system, over 400 miles of navigable waterways, gave the city a distinctive character unlike anywhere else. New construction couldn't keep pace with arriving residents. Retirees from the Midwest, families fleeing expensive coastal metros, remote workers choosing sunshine over snow. They all converged on Cape Coral with demand that seemed inexhaustible. The narrative appeared bulletproof. Population growth plus limited land plus Florida's no income tax advantage equaled permanent appreciation. Early buyers would always win. Prices would always climb. The only mistake was waiting. The median home price in Cape Coral has fallen to approximately $365,000, down 24% from the 2022 peak, according to Redfin data. That represents over $100,000 in lost equity for the average homeowner who purchased at the peak. For families who put 10% down on a $450,000 home in 2022, their entire down payment has evaporated, and they now owe significantly more than they own. Here's the impossible statistic that explains the collapse more than any other factor. Homeowners' insurance premiums in Cape Coral have increased over 300% in just 4 years. A home that cost $800 annually to insure in 2020 now requires $3,200 or more. Some homeowners report premiums exceeding $5,000 annually for standard coverage. That's an additional $350 or more per month in carrying costs that didn't exist when these buyers calculated their affordability. One Cape Coral firefighter, a public servant who risks his safety protecting the community, can no longer afford to own a home in the city he serves. He purchased a modest 3-bedroom in 2021, stretching to afford the payment, but confident that a stable government job would see him through. When his insurance premium tripled and his property taxes rose to reflect the 2022 valuations that no longer exist, the monthly payment became impossible. He sold at a significant loss and now rents an apartment. He watches his former neighborhood empty out, a firefighter unable to afford the community he's sworn to protect. The domino effect in Cape Coral is insurance-driven, but total in its consequences. When homes become uninsurable at rates that working families can afford, they become effectively unsellable except at steep discounts. When they become unsellable, prices fall to attract the few remaining buyers willing to absorb the insurance risk. When prices fall, current owners go underwater on mortgages taken out at higher valuations. When owners go underwater, some walk away. Some negotiate short sales. Some face foreclosure. When foreclosures rise, more distressed inventory floods the market, pushing prices down further, making insurance even more concentrated among remaining properties, raising premiums yet again. The canals that made Cape Coral distinctive, that appeared in every real estate listing, every promotional video, every relocation guide, now reflect rows of for sale signs in their still waters. Vacant homes multiply along waterfront lots that sold for premium prices 3 years ago. The dream that drew hundreds of thousands of people to this sprawling city has collided with mathematical reality. The brochures promised paradise. The actuarial tables promised risk. The actuarial tables won. Uninsurable equals unsellable. Unsellable equals falling prices. Fall first prices equals lost equity. Lost equity equals trapped owners. Trapped owners equals declining communities. Declining communities equals even fewer buyers. And eventually, not theoretically, not hypothetically, but visibly and measurably, unsellable equals abandoned. 10 towns. 10 variations of the same underlying pattern. Prices fell not because Florida lost its sunshine, not because the beaches eroded, not because the palm trees stopped swaying in the evening breeze. Prices fell because the fundamentals underneath these housing markets, jobs, insurance, demographics, economic diversification, eroded faster than anyone wanted to acknowledge. The brochures still show turquoise pools and endless summers. The drone footage still captures sparkling waterways and lush landscaping. Real estate listings still use words like opportunity and potential and priced to sell. But for sale signs don't lie. They sit on lawns week after week, month after month, fading in the sun, marking the distance between marketing and math. Affordability without sustainability isn't opportunity. It's a trap with better weather. The myth said buy cheap, retire early, watch values climb while your northern neighbors shoveled snow. The math said insurance premiums triple, jobs disappear, buyers vanish, and equity evaporates. Across these 10 towns, the math won. The pattern is clear for anyone willing to look. When a town's economy depends on a single industry, when insurance becomes unaffordable, when population growth stalls or reverses, when carrying costs exceed any reasonable expectation of appreciation, cheap prices are not a buying opportunity. They're a warning sign, priced attractively to catch those who don't understand what's happening beneath the surface. If this breakdown changed how you think about the Florida housing market, subscribe now and share it with someone considering a move. We read every comment. Tell us which town surprised you most. Next time, we're counting down the cities where prices are still climbing relentlessly and examining why that trajectory might be even more dangerous than the collapses we've documented today. The for sale signs keep multiplying across Florida. The question isn't whether more towns will join this list. The question is whether anyone's paying close enough attention to avoid becoming the next cautionary tale.